I think we are being lied to about oil, not in the theatrical sense where somebody stands at a podium and tells one giant obvious falsehood. I mean in the more dangerous way. The screen tells you one story, the physical world tells you another. And for a little while, long as most people keep staring at the screen, the lie can survive, but it never survives forever. That is what bothers me. Now, we keep hearing that everything is stabilizing. We are told the Strait of Hormuz is open, then closed, then open again, then maybe not really open, then technically open but functionally constrained. We are told oil is calm because the paper price is not exploding the way people feared. We are told the market has already processed the danger because stocks keep climbing back toward the highs. I do not trust that kind of calm. I never have, because the financial world has a habit of acting serene right before the physical world forces it to become honest, and I think that is where we are. Now, let me tell you the part almost nobody seems to understand. When people say the price of oil, they act as though there is one price. There is not one price. There is the paper price, and there is the real price. The paper price is what you see if you look up Brent futures. That is the number flashing on financial television. That is the number people quote online. That is the number politicians and commentators use when they want to reassure you that the situation is under control. The real price is what someone pays if they need an actual barrel loaded onto an actual ship and delivered to an actual refinery under actual stress. That is a completely different thing. And the spread between those two worlds has become extraordinary. The screen may show something around $100 a barrel. The real world may be demanding $130 or more. That gap is not normal. It is not healthy. It is not some tiny market quirk. It is the largest dislocation of its kind modern records have shown outside of entirely different crisis structures. And this one is more dangerous because it is not a demand collapse. It is a supply emergency. That distinction matters during a demand collapse. Prices fall because no one wants the commodity badly enough. During a supply emergency, prices should rise because the commodity is needed and harder to get. So when the paper market behaves as though things are fine while physical buyers are paying almost whatever it takes to secure real barrels, I do not assume the paper market is wise. I assume it is late. And when a market is late, the eventual catch-up can be violent. That is why I think this story matters so much. Not because oil itself is mystical, because oil is the plumbing system of the modern economy. It moves food, it moves planes, it moves ships, it powers factories, it creates plastics, it sits underneath fertilizer, it sits underneath transport, it sits underneath almost everything ordinary people buy, and almost everything governments call strategic. When oil is disrupted at scale, the disruption does not remain inside an oil chart, it moves outward. That is what people keep missing. Now let us talk about the Strait of Hormuz, because this is a choke point beneath the whole story. Roughly a fifth of the world's oil and gas used to move through there each day. That is not a side road, that is an artery. And if an artery closes, half closes, pseudo opens, reopens on paper but not in practice, or starts operating under such uncertainty that shipping behavior changes anyway, the damage is not measured only by the official announcements. It is measured by flow, actual flow. How many barrels are moving, how many are delayed, how many are rerouted, how many never arrive where they were expected to arrive. That is the question that matters. And by the framing of the source material, what is missing is not trivial. Somewhere in the range of 8 to 13 million barrels a day is no longer moving through the world the way it normally would. People hear that and shrug because the number sounds abstract. It is not abstract. The world uses roughly 100 million barrels a day. So this is not a rounding error. This is a meaningful fraction of the world's daily energy bloodstream suddenly going missing. And the important part is that the replacement capacity is nowhere near clean enough to make that loss disappear. The United States may have some spare capacity. Venezuela may have some. Canada may help through certain routes. Emergency reserves exist. Fine. All of that is true, and it is still not enough, because patching 2 or 3 million barrels against a hole several times larger is not a solution. It is a delay. That is what most of the current response looks like to me. A delay pre-closure, cargoes kept moving, ships already at sea kept the illusion alive, stored inventory kept the illusion alive, national reserves bought time, public messaging bought time, paper futures bought time. But none of those things manufacture new physical atoms. They only cushion the shock temporarily. That is why timing matters so much. The event happens first, the shortage becomes visible later. The physical world always moves through pipes, routes, storage, contracts, and delivery windows before it moves through the lived experience of the public. That means by the time the average person sees the effect at the gas station or in a grocery aisle, the disruption has already been working through the system for weeks. This is exactly why I think so many people are misreading the current moment. They are waiting for the visible consumer effect as proof the shock is real. But the consumer effect is the late stage. The proof is already sitting in the physical spread, in the routing changes, in the delivery breakdown, and in the desperate price buyers are paying to secure actual barrels. Now, that is the proof. Now let us talk about where the pain shows up first. Asia gets hit early, that is obvious, once you examine the supply routes. Honestly, large parts of Asia rely heavily on Persian Gulf energy flows. When those flows break, the effects show up there before they show up in the United States. Some parts of Africa get hit early too. Australia feels it. Europe starts responding by trying to manage demand. That is why you see strange behavior spreading across the globe before Americans feel a full consumer shock. Fuel rationing, electricity restrictions, substitution, emergency releases, business shutdowns, industrial strain. People stretch the remaining energy any way they can. That is what happens when a system moves from smooth operation into triage. And the United States, despite all the patriotic language about becoming the world's gas station again, is not insulated from that. That phrase has always bothered me because it confuses production with invulnerability. Yes, America produces a great deal of energy. Yes, America exports a great deal too, but the actual structure is more complicated than the slogan. The United States still imports crude. It still sits inside global pricing. It still depends on refinery configurations, logistical routes, and product mixes that cannot be wished away by branding. You cannot be a serious net participant in global oil markets and pretend global price stress will stop at the border out of respect for your flag. That is childish. America can be better positioned than some countries and still be exposed. Those two things are not contradictory, and what really matters is not how proud the energy rhetoric sounds. What matters is whether the domestic consumer is protected from a global oil shock, not fully, not even close. That is the truth. Now go one level deeper. This is not only a gasoline story, that is the beginner's version. Oil shocks do not merely make it more expensive to fill a tank. They make freight more expensive. They make industrial transport more expensive. They push up the cost of chemicals. They raise the cost of fertilizer feedstocks. They change the economics of plastics. They strain aviation. They lift input costs almost everywhere. That is why I keep using the word plumbing. Oil is plumbing. And when the plumbing strains, the effects reach places people do not associate with oil until it is too late. Take fertilizer. This is one of the most important downstream signals in the whole setup. Urea prices moving higher are not an agricultural footnote. They are an inflation signal delayed in time. Fertilizer costs rise. Now, food prices feel it later. That is how the second half inflation story gets built. Not from one giant gas price shock alone, but from the way energy filters into the cost of producing food and distributing it. We saw versions of this before. Energy moves first. Food follows with a lag. That lag is exactly what creates false reassurance in the middle. People look around, see that groceries are not yet fully repriced, and assume the energy story must be overblown. The grocery effect is simply later. That is how transmission works. Now let me bring history into this, because while history is never a script, it is often a useful map. The 1973 oil shock took about 7% of world supply offline. Oil surged dramatically. Stocks eventually collapsed more than 50% from peak to trough. Inflation ran hot. Recovery took years. The 1990 Gulf shock also took around 7% offline. But because that conflict resolved more quickly and supply was restored faster, the market damage was shallower and the recovery far quicker. What matters there is not nostalgia, it is scale and duration. Now compare that with the current setup described in the source material. Supply offline is not 7%, it may be 15 to 20% in effective terms, depending on which measurement window and which delivery flows you focus on. That is more than double the earlier benchmark episodes. So when I see a stock market acting as though nothing serious should happen, I do not conclude that history is irrelevant. I conclude that markets may still be underpricing the physical reality because paper has not yet been forced to obey physics. That is a very different thing. Now, there is another disconnect I find just as important: consumer sentiment versus the stock market. Main Street already feels something is wrong. Wall Street is still behaving as though optimism deserves the benefit of the doubt. Those two lines can diverge for a while. They cannot diverge forever at some point. Either the real economy improves enough to justify the market as optimism, or asset prices begin moving back toward the reality households are already living. Right now, I see more evidence for the second possibility than the first. I see oil strain, I see fertilizer strain, I see physical versus paper dislocation, I see a bond market beginning to flash discomfort. I do not see clean evidence that the system is gliding back into ordinary calm. And that brings us to the bond market, which is where this whole story becomes even more dangerous. The 10-year Treasury yield matters because it sits underneath almost everything in the American financial system: mortgages, corporate borrowing, project finance, valuation, math, and equities, government debt service itself. If an oil shock keeps inflation sticky or pushes it higher again, then the Federal Reserve has less room to cut. If the Fed has less room to cut, then yields can remain elevated or even move higher. And if yields stay high while the United States is already carrying an immense debt burden, then the cost of carrying that debt becomes its own problem. That is the trap. You get energy-driven inflation, you get limited policy flexibility, you get stubborn borrowing costs, and then you discover that a highly indebted system does not respond elegantly to all of that happening at once. This is what people mean when they talk about a debt spiral risk, not some cinematic overnight collapse. A system where high debt makes high rates painful. High rates become harder to reduce because inflation returns, and every attempted solution creates a second-order problem elsewhere. That is exactly the kind of setup I worry about. And the bond market comparison in the source material makes it even more interesting. Yields in several major Western economies rose as stress deepened. China's long bond yield moved the other way. That is not a small detail. It tells you something about where safety is being perceived, or at least where relative pressure is easing. Now, I am not interested in making grand ideological claims from one chart. I am interested in the margin, and the margin says global capital is not behaving as though the U.S. automatically remains the unquestioned refuge in every dimension of every crisis that matters. Because when confidence in U.S. debt markets becomes even slightly less automatic, the financing burden on a country carrying nearly $40 trillion gets more dangerous very quickly. Now, let me tie this whole picture together. We have a historically wide gap between paper oil and physical oil. We have a large supply disruption that the world cannot easily replace. We have lagged consumer effects that have not fully hit the United States yet. We have fertilizer and food pressure building behind the energy shock. We have a stock market behaving with too much calm relative to the physical strain. We have consumer sentiment already much darker than asset prices, and we have bond market signals that say the inflation and debt side of the equation could become much more uncomfortable if this shock keeps moving. That is not a resolution story. That is a delayed repricing story. And I think the biggest mistake an investor can make right now is to let paper calm him into believing the physical problem has already passed. It has not passed. It is traveling. That is the word I trust. Traveling through shipping schedules, storage inventories, fuel contracts, fertilizer pricing, freight costs, and eventually through the monthly budgets of ordinary households. So what does that mean in practical terms? First, I do not want to be overconfident in long-duration paper assets while the inflation side of the story is still unresolved. Second, I want more respect for hard assets, pricing power, and businesses that can survive a more inflationary and unstable physical environment. Third, I do not want to confuse a stock market rebound with proof that the economic plumbing is fine. And fourth, I want to remember that by the time all of this feels obvious to everybody, the most useful warning window is already gone. That is where I think we are, inside the warning window. Not at the end of the move, not after the market finished digesting it, before the physical world has fully forced the paper world to become honest. That is why I take this seriously. Not because I enjoy catastrophe, because I trust logistics more than slogans, I trust barrels more than broadcasts, and I trust the physical world to drag financial narratives back toward reality once the mismatch gets too large to hide. It always does. Maybe the move happens more slowly than people expect. Maybe it comes in stages. Maybe the paper market still squeezes higher before the physical truth becomes unavoidable. All of that is possible. But if you force me to choose between the official comfort story and the physical reality story, I know which one I trust. I trust the physical world. And the physical world is saying something very simple right now. The oil shock has not really hit America yet. It is on the way.